Smart strategy, real conversations, bigger margins. This is Chasing the Margin podcast.
Welcome back to Chasing the Margin. Today we have Mr. Alex Griffin, who is a unique guest in his own right. So we'll dive into his background, what he's got going on. But he's a little different than our typical guest. But Alex, thanks for coming on.
Absolutely, Troy. Great to be here.
So Alex, most of our guests here are like pure entrepreneurs. They just do their own business stuff, and they don't really have your background. You and I have some similarities in our background, so we'll jump into that too. But kind of tell the people who you are and what you have going on.
Yeah. So Alex Griffin, SBA lender. So mainly help people buy businesses, but also just utilize the SBA Small Business Administration lending tool. So I've been in banking for about 8 years now, and prior to banking, I'm a recovering CPA. So started my career with EY in Atlanta and started on the tax side, didn't love it. Switched over to the audit side. Shockingly, also didn't love it. And after my second busy season, just wanted to pursue something else, and have been thinking about my childhood growing up. And my dad was actually and is still an SBA lender. He's been in the space for 45 years, and so was thinking about how do I want to be able to support a family in the next 5-10 years, things like that. And so I wanted to give small business lending a shot, and that's what brought me out here to Dallas. So.
Yeah. Well, I don't know why you're one of the few people who doesn't like tax or audit work, because all of us like that type of work.
Absolutely. All the great folks over at Andy Fairchild, just, stellar work, but it's just not for everybody. And it wasn't for me, for the long term at least. But it was a great foundation, and more than anything, the work ethic that you learn, going through busy seasons and doing accounting is, top tier. So that's been great. Well,
I won't hold it against you. We'll let you slide, even though you decided to get out of the public accounting side of things.
Oh, I appreciate it.
So, Alex, for a long time, I think my heart of the podcast was I wanted to bring entrepreneurs on to give their background, their experience, to hopefully share some insight with other people who are kind of following in their footsteps. And I had this struggle with, I think you could provide a lot of insight, but you're not an entrepreneur. And then we went to lunch one day and kind of got to chatting. So I kind of had this struggle because, as you said, and just mentioned to the guests, you help small businesses or people who are wanting to buy small businesses. And I mean, that's something that is extremely valuable that I'm sure is applicable to a ton of people who are either on the show or will be listening to the show. So I kind of okay, well, I think I should invite him. And then you and I went to lunch, and I found out that you technically checked the box anyway.
Yes, yes. I'm uniquely positioned that got experience on both sides of the table. Let's just say that. My wife and I have been thinking about being small business owners ourselves for a period of time, and we're fortunate enough to recently made that dream come true. And but to your point, I think it's extremely valuable to entrepreneurs everywhere, especially those that are just getting started up or maybe are operating in an asset light space. Just what lending tools are out there for them, specifically through the SBA 7A program, but also the SBA 504 program, as far as being able to buy owner-occupied real estate for minimal money down and much longer repayment terms. It's fortunately we're in a day and age, especially post PPP, right? The payroll protection program, that SBA is certainly more well known now than it was. There's still a lot of misinformation out there, and it varies depending on who you talk to on what you think is real versus not. So would be more than happy to dispel some misconceptions and things like that.
Awesome. Well, I know that coming on here and working with a larger institution has some big pros and some big cons. But kind of tell me, what was the experience like to come onto the podcast? What did the bank think whenever you brought it up to all of them? Did they have any comments? Well, how did that go?
I appreciate that little softball there. So my bank's fantastic. They were very supportive of us. They did, want me to ensure that I have a disclaimer that, any, this is perfect, transition for you as well. But, this is not true accounting or legal advice. You should always contact your CPA as far as that goes, or the appropriate, legal counsel. And also any, opinions that I share are my own and certainly not Security National Bank's. But, I appreciate that.
Yeah, shout out to Security National for saying, "Hey, go talk to your CPA." So we recommend a CPA firm for anybody listening, and maybe we'll throw that ball back into Security National's court and say, "Hey, we recommend a bank as well if you need them too."
Yeah, absolutely. It's a great community, family-owned bank, and I'm really primarily focusing just here in Dallas because there's so much going on here. And on the SBA side, over $2 billion of SBA funds get dispersed here in DFW alone each year. So that's, there's a lot of small business owners that are making things happen, and it's just a lot of fun to be a part of that.
Yeah. Is that $2 billion like for the whole Metroplex, or is that just Security National?
I wish it was just Security National. We end up, right in that 60 to 80 million in any given year, depending on just what transactions we like or don't like. But that is the entire Metroplex for all SBA transactions across all banks.
Yeah. Well,
and some non-bank lenders as well.
That's a good chunk of that $2 billion or $2 billion.
$2 billion, yeah.
$2 billion, yeah.
So
good chunk of that anyway.
Small piece, but it's fun.
So talk to me, Alex, because I think you kind of hit on it, that maybe this was something that was a really good opportunity to support your family, and maybe you had some background in, or at least were exposed to some people in banking in your background. Why did you get into banking in the first place when you transitioned out of public accounting?
Yeah, it's a great question. And part of it was familiarity, to your point, seeing my dad growing up, being able to help small business owners throughout the community. That was always really fun to see growing up. In particular, there was a certain Mexican restaurant where I'm from in Chattanooga, Tennessee, where the owner, every time we would go, would come to our table and just say, to me and my sister, your dad was the one that helped me, when no one else believed in me. He helped me, get this business up and running, and then subsequently help, buy the building and things like that. And it was really cool to see that satisfaction, the job satisfaction side of things. And, admittedly, I referenced that my dad's been in the industry. I believe one of the few, if only third generation SBA individuals. So my grandfather, after World War II, started a small business company himself called Save a Stop, which was a C-store franchise in Florida, grew it throughout the Southeast, made an exit, and then ultimately was named the chair of the National Advisory Board to the SBA during the Carter administration. So it actually, the roots are deep in the Griffin family.
It's a nice little subtle brag there.
Yeah, gotta use it when I can. But had this background and but really didn't know a whole lot about it, and took out a few successful SBA lenders in Atlanta, and they all had the same mindset. One, that there aren't a lot of young individuals getting into the SBA industry, and two, they all had a really strong credit background. And so I knew if I wanted to get into SBA lending eventually on the sales side, I would need to, put in my time and learn the credit side of things, the underwriting that goes into a transaction, and was fortunate to find an institution in Dallas who was willing to take me on without a whole lot of experience, and trained there for a few years, and then ultimately found my way at Security National.
Yeah. So talk to me, and a lot of people may not realize that I think that you and I are a little more well-versed because my clients deal with this constantly, and ultimately your clients deal with this constantly. But what is a banker's role in the whole process? What is an underwriter's role in the whole process? What's the difference? Mm-hmm. Why didn't you stay in underwriting? What was all the change up there?
Yeah, that's a great question. So the way that I would break an SBA transaction start to finish, as far as the bank's role in the process, is there's really three main areas. And so the front area is really where an SBA lender is primarily involved. In a sense, an SBA lender is your guide throughout, the start and finish of the process, but more heavily involved at the beginning, and then really one other portion, in the middle. So an SBA lender is in charge of going out into the market and finding these transactions that are out there. Ideally, it can be years before someone executes on a transaction. It can be someone that says, hey, I'm ready to go right now. I'm just talking to a couple of different banks, and I just want to see if you're going to be a good fit or not. And so as part of my step in the process, I meet with the individual, talk with them about their financing needs, get an understanding of where are they at on the personal financial side? What's their experience like? Is it direct industry experience? Is it indirect? And this is more coming from the lens of someone who's either starting up a business or buying a business, not an existing operator.
Okay.
And then, depending on where they're at in the process, maybe they have a couple different companies that they're looking at acquiring. Maybe they have their business plan, or maybe they haven't even started that process. And so it's sitting down, grabbing coffee, and talking through, this is the roadmap to get to where you want to be. It's going to be a lot of work on your end, but also it's my role to help as far as vetting what they have from a financial due diligence perspective, from a qualitative perspective, to understanding the market, talking with them about, hey, is there significant market saturation already? Do we need another delivery app? That's not necessarily the best example, but just, is this a viable option? Does it make sense financially as well? And being able to be a good resource and sounding board from them as far as that's concerned. Ultimately, if it's something that I think that our bank would be excited about, I end up authoring about a 10-page credit memo and submit it internally and talk with our group on, hey, here's the high level, here's where we think, here's where I think this company's going, this individual's going. Mm-hmm. And, that includes, a full-blown, personal background on them, their experience. If it's an acquisition, the target company, why this is a good opportunity to buy this company. Oftentimes, the most important thing when you're looking at an acquisition is, why is the seller actually selling this business? Because if it was all great, then they would be sticking around for a little while longer. Mm. So trying to flesh some of that out on the front end, and then certainly the financial analysis that goes along with it. After I'm able to, if my credit group is interested in the deal, I'll issue what's called a term sheet. Term sheets are not legally binding. They are simply a proposal for us to say, hey, you customer, we want to get to know you a little bit better. We want to send you into underwriting, which is fully in the weeds. I'm the 10,000-foot view. Our underwriter is digging up anything and everything they possibly can, mainly on the company, things like that, the given project, but some, also on the personal side. That's us doing our due diligence to get an understanding of, has everything properly been disclosed to us? Mm. Has the borrower been asking the right questions? And if not, let's get our questions in front of, either that borrower or the seller to say, there's some aberrations in your historical financials. We'd love to understand a little bit more about those.
Yeah.
And so, once I issue that proposal, that term sheet, that's when a borrower would go into underwriting, and I effectively make the handoff to our underwriter to where they are, like I said, digging real deep into anything and everything that they can learn about that industry. We're leveraging, our past experiences in that, in a given space as well. And so depending on different, SBA groups, lenders themselves, folks will have different verticals. If someone's done 100 gas station transactions, for example, in the past, that is usually a good person to go to for a gas station transaction. Someone who knows where to look for the bodies, so to speak. And ultimately, at the end of call it a couple weeks of underwriting, that's when we would go for ultimate credit approval. And so that's where I really re-enter the scene to sit down with our credit officer and ultimately, go to bat for my borrower to say, this is the right individual for our bank to partner with. This is the right transaction, and these are the reasons why. And then we have, something that's not authored by me, it's authored by an underwriter to ideally corroborate that, or, we're fleshing everything out to say, okay, these are the things that we didn't expect that came up during the underwriting process. Maybe there was a more significant customer concentration than we anticipated. Okay, well, what are the mitigating factors? What's the length of time that the sellers had a relationship with that given customer? Is it contractual based? Is it, something that as soon as this transaction happens, that customer could, walk out with nothing? Those are things that we're trying to, make sure that we have a full understanding on before issuing what's called a commitment letter. And that's if you have, you get that ultimate internal credit approval. That's really the first time that, this is why I did this disclaimer earlier, to my understanding of when liability enters the equation. And it's really more on the bank side than it is the individual, or the borrower. The SBA program is very beneficial to borrowers in that, there's not a whole lot of legal requirements, so to speak, that are in place prior to closing. Once you sign on the dotted line, certainly an individual or a business is fully, on the hook. But there have been several transactions that, I've done and or just been a part of where a borrower gets to, the closing table even and gets cold feet and decides to pull out of the transaction. And, we kind of wash our hands of it. We'll typically get some sort of a deposit up front. But really, the only thing that's coming out of that deposit are the costs associated with doing that transaction. Maybe it's a third-party report, business valuation that we had to order, something like that. Mm-hmm. But ordinarily, the remainder of the deposit's remitted to a borrower, and we walk our separate ways. And the SBA program did that intentionally because a lot of these transactions are happening. The majority, if not all of them, are lower market transactions where sometimes borrowers are less sophisticated than more institutional knowledge. Some of those larger, more, commercial or conventional borrowers that have a whole lot of, personal liquidity, that have a whole lot of assets that they can pledge on a deal. That's not the idea of the SBA program. It's the goal that every single one of my borrowers gets there one day, and we're going to do everything we can to help guide them, steer them any way that makes sense for us to do so. But that's one of the things we actually have to check off on every single credit memo we do is something called credit elsewhere to determine that an individual can't access conventional credit, because if they could, they wouldn't necessarily be able to borrow through the SBA's program.
Yeah, for sure. I'm sure that you've experienced this a lot because we experience this a lot. It's you sit in front of somebody and you talk to them and you ask them questions about whatever it is that they do or whatever it is that the businesses that they're trying to purchase that they have an extensive background in, and you see this person who is just incredibly knowledgeable, who's really good, who maybe has a great idea, who you feel like is fully capable of doing what they're trying to do, but then they might have no real understanding of like how the financials work, may not be able to read financials. They don't really understand how like loans work or how term sheets work or anything like that. And you get to sit down and explain to this person who, if they can just get a little help with those pieces that they're not an expert in, that they will fully succeed. And I'm sure that that's extremely rewarding with being that support system for this person who is going to jump out there into the deep end. And as so many of the guests know, it's like, man, you either sink or swim, and you as the banker are like, hey man, you can do it, but like, we're here to help. And I'm sure that's super rewarding to do that.
It's, it is great. And working with entrepreneurs every day it's infectious. It's so much fun being a part of these transactions with, previously not having, skin in the game on on anything like that. Mm-hmm. And I've always, I think you can certainly appreciate this. One of the things that attracted me to accounting to begin with is I've always been fascinated by the way people make money and just different business models and how you can be successful, but there's no one blueprint, right? Mm-hmm. And those are, I would say, some of the more special transactions are the ones where an individual, let's say just as an example, someone's a mechanic and they've been working at a mechanic shop for several years, and maybe there is a succession plan already in place at that given shop. Well, that person, has the experience, and maybe they want to go out and either start their own or acquire an existing one. How can you ask someone who's been a mechanic their whole life to then, at the drop of a hat, be able to, put together 2 years of projections, really detailed, and, form their own entity and things of that nature. And the reality is, they wouldn't be as good of a mechanic if they were good at some of those other areas. There's something to be said about being a jack of all trades, but also in a more specialized area, you want someone with that deep expertise. And so those are extremely rewarding situations where I can steer an individual to say, hey, do you have an attorney? Do you have a CPA? Do you have an insurance individual? If not, I'd be happy to introduce you to some folks who are going to be fantastic and help you get this to where you want it to be. Or conversely, and sometimes more importantly, have another voice in the room that says, while this is a great idea, the financials just don't make sense either at this given point in time or at the scale that you want to do. And that's, significant as well. So it's always good to have another professional in your corner outside of just the bank. It is always our responsibility and our prerogative to help borrowers succeed and to vet their transactions. But, no one's perfect. And so the more intelligent people you can have in your corner to help you and build out your team, it's extremely valuable.
Yeah, I'm going to be honest with you. I don't really care if my mechanic can read financials properly or not. As long as he knows what's going on with the car, I'm okay with that.
That's exactly right. That's exactly right.
So you've kind of just mentioned a couple of times that there are differences in like commercial lending and the whole SBA program. And you and I have talked about it a decent amount, but just for the average person who doesn't know a whole lot about banking, what are some of like the real big differences between the two of those?
Yeah. How much time do you have? So I will try to keep it high level. I have a tendency of going a little too far in the weeds. I still blame the accounting background for that. But an example that I give, it's not foolproof, but it's a nice illustration is, let's say that an individual wanted to go buy $1 million business. If you wanted to do that via conventional or commercial credit, you would likely need to have 25 to 35% of that project cost in the form of your down payment. So let's say that leaves $600,000 left in the term debt. You would, or let's 700, just to be accurate here.
A little more. Yeah.
So let's say 700. If you were going to go that conventional route, you would need to collateralize that with something. A bank's not just going to say, hey, we love the cash flow here, and that's enough. We want to have some sort of guarantee outside of even a personal guarantee that you're going to pay us back. So
I can't just come in and be like, hey, just trust me, this is going to work. And
exactly.
You guys are good with it.
Exactly. So you can, whether that's a second home, a rental property, maybe it's commercial property that you own, maybe you're cash securing it, so you're leaving a significant certificate of deposit at the bank. Those are factors that will get conventional credit excited about a deal. And if you don't have that, your chances of success are extremely low.
So somebody that's kind of like already established with life, that's maybe gone through some of these things, built up a little bit of net worth, et cetera.
That's exactly right.
Okay.
Now, if that same individual wanted to acquire a business through the SBA, they could put down as little as 10% on their down payment, and then there does not need to be collateralized assets there because the government is guaranteeing 75% of a bank's risk in this transaction. So it enables banks to do quote unquote riskier transactions because they have this government, backing behind it. So if that's a very asset light business, let's say it's an advertising agency or something like that, we would get 10% down from the buyer, assuming the cash flow is there, and then we would get a $900,000 life insurance policy, and that's that's it as far as being able to access a credit like this. There's certainly more intricacies. We'd want to see that there is a sufficient amount of cash flow in that business to be able to repay that debt. The way that the SBA deems sufficient cash flow is 1.15 times debt service. So if your annual payments are $100,000, they want you to have at least $115,000 a year in cash flow. I can guarantee you, though, no lender in the country is doing a deal that's that skinny. Mm-hmm. But, traditionally on acquisition deals, we want to be at about 1.5 times debt service to feel comfortable on the bank side. And, candidly, also a borrower should want to feel that level of comfort as well. And that's certainly an indicator if, someone's taking their transaction to several different banks and they're getting turned down at every one. That might be a time to kind of look yourself in the mirror and figure out, is this really the one for me? Or
maybe it's not them, maybe it is me.
Yeah, exactly.
So that's interesting. I don't think I've ever heard, is that like a standard that the life insurance policy thing comes into play just as a safety net for like all of these deals? Is it most of the deals? Like how does that
So it's a requirement whenever there's an uncollateralized portion of the debt.
Okay.
So we are still required through the SBA's SOP to get, if you do own a rental property, we are required, as long as there's 25% or greater equity in that property, we are required to place a secondary lien on that. In the state of Texas, the homestead laws, we can't require, a personal residence to be put up as collateral. Mm-hmm. However, every other state in the country is, you have to put up your home to get an SBA loan.
So Texas is the only state that's like that?
Yes.
Oh, interesting.
There may be one or two. So I, want to go back to that disclaimer earlier. But since we do, my bank operates Texas, Nebraska, and Iowa, and been in Texas for 8 years now. I'm very Texas focused, so I know for a fact that we can't touch it here.
Yeah.
And so that's really the only significant collateral that we would look for outside of assets of the business. Certainly, we have to have a first lien on the business, but any collateral shortfall there is shored up with that life insurance policy.
Okay, I got you. So, what are some of like the standard terms for anybody who's looking for a loan, and maybe they could do some quick math on an Excel spreadsheet to just like, okay, obviously they've got to go through this whole process, but this is kind of a normal type situation.
Mm-hmm. So one of the best parts about SBA debt as compared to conventional debt is the term. Mm-hmm. So the longest conventional term you're going to get is 3, maybe 5 years. And if you're lucky, you'll get a 7-year amortization. I know certain other, verticals get a little more preferential treatment than others, but by and large, that's what a typical conventional note looks like.
And break that down, like what's the difference between the term and an amortization schedule for those who don't understand it?
Absolutely, sorry. So the term is when that note matures. So, it could be 3 years, 5 years, 7 years. The amortization is how those payments break down on a monthly basis. So a nice part about an SBA loan is that a standard loan, non-real estate, is typically going to be 10 years fully amortizing. So whenever a note is fully amortizing, that means when you make your last payment, the note is done. Mm-hmm. If there's a difference between a term and an amortization period, that's when there's going to be what's called a balloon or a bullet attached to that transaction. So if it's a 3-year note with a 7-year amortization, you're going to be making payments month 1 through 36 as if it were a 7-year note. However, by the time 3 years is up, you're going to have a lump sum that's due. Basically, the remaining unpaid portion is going to be due to the bank. Most of the time, when that's the type of structure that's in place, an individual will refinance that note. So, say, hey, assuming that things have gone well with the business, most banks are going to be interested in refinancing that borrower. Where folks can get into a little bit of trouble is, if things have not been going well with the business, if they haven't been, answering their banker's call when they do give them a ring or stop by the shop or something like that, and the relationship is soured, that's when that individual would need, to go look elsewhere, shop around to see if anybody would be willing to take on, that balloon note. So that is, from a term perspective, a really nice part about SBA lending is, you can technically do a working capital loan at 7 years. Reality is almost everyone in the industry will do any transaction type outside of commercial real estate at 10 years. And then on a commercial real estate side, as long as over 51% of the loan proceeds go towards commercial real estate, this is owner-occupied commercial real estate, that's actually on a 25-year term and amortization. So you can really stretch out those payments. It's a lot more affordable than if you were to go the conventional lending route. And that's by design through the program, right, to help individuals who don't necessarily have the means that conventional, candidates do, to be able to still, acquire a business, start up a business, especially starting up too, right? The first 12 to 18 months, you are trying to keep your head above water, anything and everything, you're scratching and clawing. The last thing you want to do is be, worried about your note ballooning in the first 3 years. And then, so it's certainly nice to have that longer repayment period. And ideally, before the end of that term, you can refinance conventionally. You become qualified to access, conventional credit, and then you can kind of take advantage of both to where you can get into an SBA note for as little as 10% down, and then, refinance to take advantage of that lower interest rate that is typically associated with a conventional note. So a completely ordinary SBA transaction will be Wall Street Journal Prime plus 2 3/4 floating calendar quarterly.
Which would be what today?
9.5% today.
Okay.
Depending on the SBA lender, depending on what they want to, accomplish. So, for example, some SBA groups are designed to where they need to charge that in order to keep the lights on, and that's their decision to build their business unit that way. Mm-hmm. Other SBA shops will say, while this is SBA, it's almost to that conventional credit quality, but it's not quite there. We think these folks are worth coming down on interest rate on. And so that's where you'll see some SBA notes that have, prime plus 2, prime plus 1.5, something like that. But the, completely average SBA loan out there will be that prime plus 2 3/4. And when it is priced at that point, it's going to be about 200, maybe 300 basis points higher than conventional credit, so 2 to 3% higher. Mm-hmm. You get the benefit of that longer repayment period, which ultimately you are still paying less on your monthly payment as compared to conventional credit, but you're going to pay a lot more interest over the life of that loan.
Yeah, I got you. So it's basically boils down to conventional credit is or conventional loans are kind of better when the numbers are broken down. But then SBA is really trying to help all of these people who don't qualify for it, or like you said, and I've seen it so many times, when you start up a business, the first 2 years is like such a difficult time and can be so up and down because there's just no way to predict some of these things, that if it's a 3-year note, it's like you're really pushing the boundary here, because if you're not really doing great after year 2 and then year 3 you have this huge swing up, well, I don't think the bank's going to be like, hey, you had one great month last month, so we'll just go ahead and renew you. There's probably some additional challenges that could come into play with something like that.
Definitely. And in general, startups are, very, very few commercial lenders anywhere will do a startup. So that is, if you're starting up a business, SBA, and you want to retain a significant amount of ownership in the company, SBA is a good route for you. Mm-hmm. Without, those deep pockets, really only folks with deep pockets are going to be able to accomplish a startup via conventional credit. Starting up a business, you can finance machinery and equipment. We talked about business acquisition, working capital as well. And working capital transactions through the SBA, when they're not startup specific, are typically project oriented. So maybe you just won a major contract and you need to add 20 folks to your machining shop in order to accommodate that contract, that's a situation where a bank would get excited about a working capital deal. Traditionally, they're not the most exciting from a bank's perspective because while we do have this SBA guarantee behind all these deals, we never want to call the government and say, you never want them to actually have to honor it. It's like this cat and mouse game a little bit, to where you feel good having that guarantee, but if you're the bank that ends up calling the SBA, several times a year saying, another one just went bad, eventually you'll get under the microscope and you likely won't be doing SBA loans for too long.
Yeah, and then just to point out another really important thing that you mentioned there, just to make sure people catch it, for any deal where you're buying a business that does have real estate, and you said that like the amount that's being lent is for the value is 51% towards the real estate, then you can stretch that out over 25 years, which for anybody who has looked at any type of amortization schedule, the payment on a 25-year loan is extremely helpful to be able to cash flow yourself. And a lot of times, like especially the example you gave where you win a big contract and you have to hire all these people, the numbers will all make sense. It can just boil down to a cash flow game. It's like, can you survive the cash flow to get to the end result? And when you have a loan that's structured over a 25-year amortization because of the real estate involved, it's something that can really make or break the business itself.
Absolutely. And the SBA, cash is king. I mean, that's no matter what, as long as an individual is able to, through the business, support the cash flow requirements of that business, like that is what SBA lending is for, right? It doesn't need to be collateralized. It doesn't need to be asset heavy.
Well, talk to me about, I'm sure this might be a sensitive topic for people who considered doing something 5 years ago and now have changed. How have things changed since like COVID, and how have rates fluctuated with the Fed rate changing? Like, what did the landscape look 5 years ago versus today? I know that the PPP stuff is a whole other beast, but maybe just like terms and rates and stuff, how is that different?
Yeah, so a nice part in general is just that the term stays the way it is because of the SBA standard operating procedures. They'll typically publish one time a year. We've had several updates, since this new administration has been in place. But so that's nice as far as the term, and then rates as well. I mentioned prime plus 2 3/4. That's like an industry term, an industry standard. Well, prime changes, right? So these are floating, more often than not, they are floating rates. And so there was a period of time, during COVID where Wall Street Journal prime was 3.25%. So that means, a 6% rate is fantastic on SBA debt. I'm sure there are a lot of folks out there right now who would love to have 6% on their SBA rate. Unfortunately, when inflation started running rampant, the Fed quickly raised the Fed funds rate, which they should have done and, did appropriately, right, to combat inflation.
Right.
However, a lot of small business owners got caught in the crosshairs of, they had modeled, and even SBA shops as well. In general, when you're doing cash flow stress testing on the bank side, we're looking at what the rate is now, but also, what does it look like if it's 200 basis points higher, if it's 2% higher? Thinking that's a worst case scenario.
Right.
Well, shoot, the next thing you knew, you blinked, and Wall Street Journal prime was 8.5. So folks were paying 11%, or higher interest rates, and it caused a lot of folks to have to, shutter their business because it just ate too much of their margin. What
was maybe one of the biggest jumps that you saw from back then to today? Was it like around that, I guess, 5% from 6 to 11? Did you see some that went above 11 that were originally like a 6%? How bad was it?
Yeah, that's a good question. So there is another nice part about SBA lending is that there is a cap. So the absolute most that someone can charge through the 7A program on, it's a little bit different for small loans. So by and large, this is going to be called $250,000 or greater in SBA debt.
Sure.
it cannot be more than prime plus 3. So even at its highest, 8.5, I believe, is the highest that Wall Street Journal Prime got. So 11.5% would have been the ceiling that we could have seen. You can charge a little bit more on SBA Express lines of credit, which is another credit facility, through the SBA. But by and large, the most that you were going to see was 11.5%, and unfortunately, you saw that a good bit. There were a lot of folks that were, called several other SBA lenders to say, hey, this, my business cannot continue to function at this interest rate. Can you all refinance me out? And that is extremely difficult to do. With refinancing SBA debt with SBA debt is nearly impossible. And so the only person or institution that could have given them interest rate relief is their primary lender. And, unfortunately, some folks were not able to get that interest rate relief from their institution.
Yeah, from what I've talked to you about, it seems like in general SBA lending has its pros and cons, just like anything else in business. It has the longer amortization schedule or the longer loan terms. It has the smaller amount down, assuming that that is possible. But then, it's got cons like this situation that nobody could have really predicted, with things just ramping up like that. But even conventional loans still were impacted some. So, that's kind of give and take there with both sides of the apple. But then also SBA has like, hey, this is kind of what you agreed to, and we agreed to it, and it just is what it is sometimes.
Yeah.
But I think in business, that's the unfortunate truth in business sometimes is, hey, there's a lot of risk reward, and one of the risks is sometimes it just is what it is.
Yeah.
And you can't really change it.
Yeah, and we've talked about a couple of the downsides to SBA lending, the rate, seeking out all worthwhile collateral. So, if you are somebody who has one or two rental properties and you live in Texas, those are going to need to be pledged as collateral. The main one, though, that my dad is just shaking his head right now that I haven't brought this up already, but every single SBA transaction has at least one personal guarantee tied to it. And every owner, 20% or greater, is required to sign that personal guarantee. So, it means that if everything goes to hell in a handbag, then you as an individual, if you're the one that signed that personal guarantee, you are going to be responsible for paying that money back to the bank and, in effect, to the government. But it is truly bank dollars at the end of the day that the government is supporting. And so, that's difficult, especially when you're in a situation where there's these interest rates went through the roof. And so there are only a few options when you kind of get into that situation. And ideally, you have a really good relationship with your bank, with your lender, because the more transparent you are and have been with your lender, the better your chances are of a bank working with you through some of those difficult times, if you can. If there's a light at the end of the tunnel, we've had situations in the past where there really wasn't a light at the end of the tunnel, and so it was sitting down with the borrower to say, look, this was your passion. You left your corporate job to go pursue this, this startup transaction, and it's not going to work. Like, we have to be the ones that are the splash of cold water. And, it's just saying, hey, there's going to be, a certain amount of money left over. Is there a way that we can, change the terms of this note potentially to say you go back and work in corporate America and you'll chip away at this over time to try to avoid the bankruptcy route? Because ultimately, if there is no other solution, that is the route to pursue from a personal perspective, which is not ideal. But to your point, it's, it has these pros. And so you've got, the government wants to have skin in the game, and they require it. So
yeah, I think that, like, anytime you start talking with these numbers, and like we mentioned earlier, when numbers is not your forte because something else is your forte, all of this can seem really scary. But time and time again, I've seen, and I know you've seen as well, where these people are really great at what they do, and they're just like not asset heavy as individuals. They don't have bukus of cash to put down. They have enough to put down to meet SBA requirements. And the SBA kind of like being the one to bet on them. With an entrepreneur, the ceiling of what you can make or the lifestyle that you can kind of provide your family with some of the advantages that entrepreneurs get. All of these things are the reasons why SBA is so amazing for people. Because, if somebody starts a business 5 years ago and then slowly chips away at it and is a hard worker and is willing to put in whatever it takes to get it done, and then they end up making, $500,000 to $1 million a year and pay off their loan, and the only way they were able to start that was the SBA route, and they wouldn't have gotten it otherwise, then that's what SBA is kind of like. If they're trying to paint this picture, this is the person that they're trying to paint as like, this could be you type situation.
Yeah, and I'll tell you, one of my favorite stories as far as, and it really is, you're helping somebody pursue the American dream, truly. Yep. And one that I'm a Jacksonville Jaguars fan myself, but Shad Khan, the owner of the Jacksonville Jaguars, started his career with an SBA loan. He bought a secondary auto parts dealer out in California, I believe is where it was. But so you can start with an SBA loan and one day own an NFL franchise, which is pretty remarkable. And there are success stories like that all the time. Certainly that's more rare than the more common outcome. But you're exactly right. To be able to take the knowledge that you've gained as an individual, as an entrepreneur over years and years of experience, and to be able to put that into a business acquisition. And I've seen several different scenarios from an individual doing it by themselves, and that is typically the most common, maybe one or two, but also this entrepreneurship through acquisition, ETA, has become very popular in the past few years, and not all these folks have deep pockets yet to be able to, deep pockets even in the SBA sense, right, to be able to acquire a $5, $7, $8 million business. And so it's those individuals that also are raising money from minority investors, typically family and friends, but sometimes, folks they might get connected to through an alumni group, someone like that. Those are, other ways to be able to leverage your knowledge to acquire something that's, maybe certainly bigger than what you could have done by yourself, and then finding the right fit from the financing side, the right bank that wants to do that type of a transaction. Because even within the SBA space, a lot of different lenders have different areas that they like to focus on. Some, will only do owner-occupied real estate, it's the safer route. And then, some folks are more preferential towards business acquisitions. And we're at Security National, we're more generalists, but I would say we lean more into the business acquisition space. And then, some folks will do absolutely anything, startups, working, what have you. It's very fun to see, especially when, it's somebody who either was turned down at a couple other places before I got introduced to them, to bet on them, to go to bat for them, and then to subsequently see them succeed is really, really incredible. I had one situation a few years ago where an individual, I got connected to him, and he's just like, I can't get, my SBA lender to call me back. I think I've got a really good deal here, and had him send me over the information, and that was a situation where he did, raise a little bit of money as well. He had great experience, but just didn't have the funds to even be able to put down the 10% himself. And, sent over the financials, and it was a little funky the way that it was reported on a tax return, but spent about an hour on the phone with the seller's CFO and CPA and was able to kind of vet all the numbers. And I was amazed by how incredible that deal was from a credit strength perspective. And there was some real estate. It was a business acquisition as well. And ultimately we were, fortunate that I got introduced to that borrower, but also that borrower picked us too, because oftentimes folks are talking to a couple different SBA lenders. You want to cast a wide net if you can. But I can also, personally attest that, you don't want to talk to too many because just from a time perspective, personal bandwidth, some folks do this as their full-time. Mm-hmm. I'm going to leave my current job to go pursue acquiring a business or starting a business. But some folks are, still working a 9 to 5, at least a 9 to 5. And then, so they might not have all the time in the world to be able to talk to 10 different lenders and see, who's the right personality fit, who's, going to be close enough on rate to where, I can still get excited about doing the deal with them or not. And so that's a fun part of it all.
Yeah, well, let's dive into something that I think I hear a lot on like podcasts or social media. Just hear people talk a lot about, and I'd like to hear you clarify some things. Let's say it's a business that's $1 million, and like everything looks great on paper, and it's somebody who has probably a background working in that industry that they want to purchase this business. But especially like some of the younger people, if it's $1 million and it's $100,000 down, they don't have $100,000. They've got every criteria that's on your list that you guys would be looking for, but they just don't have $100,000. Mm-hmm. So I've heard that there are other options where you guys can still check off the box without necessarily them coming, specifically them, $100,000 out of pocket. So what are some of the things that you've seen in the past?
Yeah. So I think what you're referring to is it is typically, you're right, it's reserved for situations, at least in my experience, where it's either an employee that's been working at that business for years mm-hmm. or they have great direct industry experience. You don't see this type of structure happening a lot with what's called indirect industry experience. So someone, again, just doing something outside of their area of expertise, but you can kind of justify, you as the bank can kind of justify, well, they have a strong personal financial statement. They've got some of the leadership skills that we think would be applicable in this new line of business to where, we would be interested in taking that risk. You can do it for 5% down. And so that is the bare minimum that an individual will need to come to the table with, or at least some of the ownership group will need to come to the table with to help accomplish that. If that's the scenario you're going, or the route that you're going, then you need to have at least a 5% seller note. And this is total transaction, I should say, total transaction cost as opposed to just the $1 million business. But for the sake of keeping things a little simple here, we'll say $50,000 and $50,000. If you're using that as equity injection on the deal, then that seller note needs to be on full standby for the term of the note. So effectively 10 years, that seller's not going to see a penny because they had to help this individual acquire the business. And so that's oftentimes why it'll be reserved for someone who's been working at a company, to where it's kind of hard to rationalize someone who's just walking off the street, hey, here's $50,000 that I'll never see for 10 years unless they just, really have to get out of that business. But then again, that raises a whole bunch of other questions, right? So I think that's what you're referring to as far as, you can do it for as little as 5%. Previously, under the previous administration, you could get away with as little as 2.5% down. But unfortunately, a lot of those transactions that were getting done with that little skin in the game did end up going belly up pretty quickly. And so the new administration stamped that out very quickly and reverted back to this 5% down, route.
Yeah, that's kind of what I'm talking about is like with the 10% or as low as 5%, I'm sure that there are situations where you guys want a larger down payment percentage-wise, and somebody may not have that. And the current owner could do a seller finance on some of that stuff to help bridge the gap. And, for $1 million deal, that's a significant number for some people. But on some of these other deals, they can start to tick several million, and the larger the top line number gets, the larger that down payment number gets. And even people who are established in life, if the top line gets so big, that down payment is so large that they just probably would have to look at the seller, and especially if it's somebody that they've worked under for years, that they know they can carry the business, and just say, hey, I can buy the business, you can take your exit, but there's no way that I can do that with this. I'm going to need your help. And I think just having those candid conversations with somebody you're buying a business from can really be helpful. And like a lot of times, especially when you have, a banker behind you that can explain things of like, hey, this is things that they've seen in the past, or this is like some options you have. They can help you walk through things being possible that you may not have thought were possible by just running things by yourself.
Yeah.
So
definitely. And to your point I'm trying to think, I think I've only done one business acquisition in the last 3 to 4 years that did not have some sort of seller debt involved in it. And so the most common type of an acquisition structure over the past few years has been the 10-10-80 split. So 10% down from the buyer, or the buyer, along with some investors, 10% of that via seller note, and then 80% SBA debt. Ideally, we want to be anywhere from 70 to 80% on an acquisition transaction.
Okay.
As far as, our debt piece. Some of that, certainly cash flow, alleviance. Making it a little bit easier on the company from a cash flow perspective. And what's also industry standard when you do have those seller notes is to actually have them on a 2-year full standby. And so that, helps cash flow certainly. That means that payments are starting on that seller note starting month 25. And so it gives the buyer 2 years to be able to really get their arms around a business before, kind of that uptick in debt service comes along. We on the bank side really like seller notes because it keeps the seller invested in the company long term. They are not incentivized to go, while every seller is going to sign some sort of a non-compete, non-solicit, not everyone out there is the most squeaky clean of characters. And so, you see that sometimes. And a seller note's a great way to disincentivize someone from going out and, potentially doing something that might hurt the business, or, advising a customer to leave because they ideally want to see their rest of their paycheck down the road a little bit.
So when it comes to people who are considering the SBA route and just considering buying a business, need cash, et cetera, what are like some of the big things that you look at that are like, these are immediate either red flags or things that are not really great that somebody could try to fix on their own side or keep from happening before they come to you, to where they can be as prepared as possible before jumping into that conversation?
Yeah, that's a great question. The number one thing that someone can do proactively ahead of time, which it sounds, like common sense, but also, especially if you're head down trying to find a business or start a business, you're not always thinking about is doing a hard credit pull on yourself and potentially your spouse, if your spouse is also going to be joining in on this, or a business partner is pulling your own credit. Because I can't tell you how many times, we'll talk to somebody ahead of time and be like, are there any issues with your personal credit? No, everything's great. And then you are required to pull credit on an individual on every transaction. And then it shows up, hey, there was a medical bill that's been outstanding, that's past due, and that's, not great from a credit perspective. It's something that a borrower, a potential borrower, it's a small action that they can take to completely change the narrative. So whenever we have to go to someone to say, hey, we saw that there's this medical bill outstanding, you're 90 plus days, delinquent, what's the story? And the person says, I don't know, let me figure it out, let me fix it. If someone were to do that proactively, they find out that they have a medical bill that's 90 plus days outstanding, they take care of it before they apply for the SBA loan, it's still going to show up. It's going to sit there for 7 years on your credit report. But when you submit, for your loan application, you can say, hey, by the way, this is on my credit history. These are the steps I took to remediate it. That completely changes the narrative from our perspective. We're looking at someone's character. We're looking at someone's, just a variety of different things that go into what makes their borrower profile. And when we talk to someone who is proactive on managing their personal credit, that has made these, steps ahead of time, that's someone who's, done their homework, they're studious, they're ready to take on, hundreds of thousands, if not millions of dollars worth of debt Whereas someone, they're proactive as opposed to reactive. If someone's reactive, that's not necessarily someone that we want to partner with. We want to have somebody that is thinking about these things, or that they've surrounded themselves with a team that's advising them to, in our example earlier, a team that's helping, that's providing some of this, the checklist, the things to do before you're really ready to be able to take on this kind of debt.
Yeah, one of the things before maybe we cover a couple examples that I wanted to talk to you about, because I feel like you're a little unique in your approach to business with this, and I think that people don't understand the impact it can have. So you and I met at a CPA event.
We did.
Which is just really a networking event, is really what it is. And I know that you spend a lot of time seeking out proactively just random events that you can go to, or events that maybe you get invited to. And a lot of people do not like going to events like that. It's awkward. You have to talk to people that you don't know. And a lot of times they can just be something you go to. You don't meet a single person that's valuable to you, at least in the immediate. And it's just hard. And networking events, I think in general, are hard. And probably just about everybody there feels awkward.
Yeah.
But tell me, from your perspective, and then I'll give you some feedback on my thoughts. Why do you spend all this time going to these events? Maybe tell me some of the things that have come about from some of those events. Why do you take time to do it when so many people don't?
Yeah. Part of it being, the nature of my role, right? There are some SBA lenders out there that get a bunch of internal referral leads. Maybe they work for a much larger institution where there's a huge pipeline that's coming right onto their desk, and they're not, they don't need to go out and find new deals. We're a community bank. We've got 200 plus employees, and that's fantastic. But also, we are, incentivized certainly to go out. We being, myself and my peers are incentivized to go out and find new business. And it's part of that being proactive instead of reactive. We could sit back and just, kind of farm what comes in. But especially in a market like Dallas, there's so much, DFW, I should say. My friends in Fort Worth would be angry with me if I didn't. But there's just so much out there that, if you're sitting behind a desk, you're gonna miss it. And I can 100% attest that I'm pretty sure nobody enjoys going to networking events. I know that especially early on in my career, I'd need to, I'd sit in my car for a little bit and play a pump up song before getting out and just talking to complete strangers about who knows what.
Yeah.
But I've been very fortunate that I've found some great people, yourself included, from going to these events, and I've always kind of had the mindset of, if I can just meet one person that's worth it, then it's time well spent. And now 8 years into my lending career, it's amazing the brief encounter you can have with someone, and then how it can come full circle. And so I've there's one example where I'm actually ashamed to admit this. I don't even remember where I met this individual, at a networking event. I got a call one day from a number I didn't realize, didn't know, and took it, and this person said, "Hey, I've heard that you are really active in the SBA lending space. You're local here to Dallas. I've got a transaction I'm looking at, and so do a couple other of my friends. Would love to sit down and get to know you and see if we could be a good fit." Had a great brief conversation. I ended it and I was like, "Hey, so and so, what, if you don't mind me asking, how did you get my number?" And he's like, "Oh, well, I was at this M&A event and your name came up, and that individual gave me your number." And for the life of me, I could not remember that first individual's name. I was like, "Oh my gosh!" Well, just super, super grateful that they remembered me, down the road, and since then have been able to do a lot of business with that individual. And so some of it's just you're out there, you're planting seeds, and you just don't know which one's going to grow and which one's not. And I've personally found that I don't necessarily operate great in the big business development settings. But to that earlier comment, if I can find one individual that's worth getting coffee with later, that's where I really, thrive, is one-on-one, maybe max like 4 people in a given setting, to where, I feel like you can do more than just kind of change business cards and exchange business cards. And you get to know, the person, their person's family. Again, part of it is that character aspect that you're trying to ascertain on any deal. Part of it is just that part that I enjoy about this is, you get to know so many different people, and who knows where they're going to be one day in their career. But if I can be, that stepping stone to help them, take that next big step in their career, and I'd love to do so. And so that's the rewarding part for me, is finding those individuals, but it is not easy.
Yeah, I think that's been my experience too, and that's what I would tell anybody who's listening is, it's so hard to go to those events, especially when you've already worked an 8-hour day, and it's going to be a nighttime event. You're going to be there at least 2 hours. It's like, nobody wants to do that. But you go and you meet somebody, and sometimes you'll meet somebody who they could be a client. Sometimes you'll meet somebody who down the road, like just in your example, they have a friend or a family member or one of their clients that need your services, and they just happen to remember you. And I think that people just really underestimate how much of an impact you can have by, as you called it, planting seeds. And if you just keep churning at it and I like how you said that, like small goals. Like, I'm just going to try to meet one person that I really feel like I connected with, that I can just go get coffee with later. Like, doesn't have to be more than that. Doesn't have to turn into anything. But if you do that enough times, it will turn into something with some of those people that you just meet at the networking event and then go grab coffee with later. So I just feel like people really undervalue that, and especially when they've got other stuff they could do. But if it is part of your role, whether that's somebody who's like you, who business development is pretty much your role, or if it's somebody who is in the craft itself that their business is doing, but also like they need to grow the business too, I think it's a valuable tool to use. So I was going to ask a couple examples, but I think we'll pass on that today. Let's just cover a couple more things and then end with some fun questions. So when you get introduced to somebody for some SBA lending, is Security National also something that can help these clients with their other banking needs? And if so, like, what are some of the stuff that you see where somebody comes in for SBA lending and then they end up needing like several other things?
Yeah, absolutely. So Security National, we've got a great private wealth group. That's usually not going to be somebody with me just yet on the SBA side. We've got a full personal and retail banking side. Commercial real estate, and then C&I lending or conventional lending are really our main pillars. We've got a mortgage lending group up in Nebraska as well, which is kind of the mothership up there in Omaha. But it's, absolutely. On everything that we're doing, we've got a credit card group. We're trying to figure out how we can kind of piece this financial puzzle together for the borrower. Mm-hmm. And sometimes folks will come in and say, hey, I want to get an SBA loan. And, I'll sit down and look at the financials, and I'll be like, well, the good news, for you is that you should be talking to our conventional lending group. Let me introduce you to, my coworker Ian or Mike or someone like that. Mm-hmm. And so we are always trying to figure out, the best way that we can, serve our customers. And ideally, too, by being able to put multiple products together for an individual, we can actually oftentimes lower that interest rate on their term debt. And so, in the same way that you can bundle things with insurance, see those commercials all the time, you can do similar facets like that with SBA lending, and we try to do that as much as possible. We're owner occupied real estate, and our commercial real estate group will certainly do like multifamily projects. They are certainly not as limited as we are on the SBA side, but so we've got That's really, I would say, the main portion. We've got, like I mentioned, private wealth. We've got a trust group as well that's fantastic. They're primarily based up in Nebraska, but they've service all of our customers here in town. And so anytime we can cross pollinate a little bit within the bank, I know the powers that be love that as well. And really, as long as we're delivering, top quality customer service at the end of the day, it's something as simple as just asking the question too, because it might be something that a borrower has on their mind, but they might just not know if you're the right person to ask and might just keep that to themselves. So oftentimes it's the same question about, built surrounding someone with a team is, hey, do you have a CPA? Do you have an attorney? Or have you thought about setting up a trust involved in this business? Is this going to be a legacy thing that you want to pass down to your family? If so, you may want to talk to someone in our trust group about, the correct way, and then also call Troy and ask from a taxation perspective, what's going to be the best vehicle to utilize to do something like that.
For sure. And then I wanted to just give you an opportunity because, I know a decent amount about what you do, but anything that I didn't ask a question about or just in general with SBA lending or lending in general that maybe people should just be aware of? Is there anything on your mind that we just didn't cover?
I think we hit the majority of it. It's in general needs to be a for-profit business in the United States. A recent change that has impacted more businesses than you might think are that no one in your cap stack, so your ownership group, can be a non-U.S. citizen. So that is a very significant change that the new administration made. Previous, even if you're a green card holder right now, you cannot, and you had been able to for over a decade, access the SBA program. You cannot do that any longer. So that's certainly an aspect. I think we've done a pretty good job of hitting the major points, and there is a lot of nuance to it as far as eligibility goes, and we don't need to get too far into the weeds between the active generation of revenue or passive generation. So like single multifamily is not eligible. Any sort of spec homes are not eligible. It needs to be something pretty concrete in the eyes of the government on how they're going to get repaid. Religious organizations are not eligible. Some establishments that you might find in like Las Vegas are ineligible. Anything related to gambling is ineligible, and so those are pretty quick vets up front as far as, hey, this isn't gonna work out here. But by and large, most of the businesses that you drive by, certainly the mom and pop shops, those are all going to be viable candidates. Either if you're an existing business owner and maybe you have some, you were in a tough spot and you pulled out a bunch of, business credit cards that are at high interest rates and you want to refinance that. That's an eligible use of proceeds through the SBA. I don't think I had mentioned debt refinance just yet, but, anything that does have a balloon tied to it that you're unable to pay, the SBA says that, hey, you can refinance that, with SBA debt. So that can also be a big, lifesaver for folks out there.
Awesome. Well, I feel a great success that I covered most of the basis. Is there any type of limit or range that really works well for SBA, whether that's you specific or just SBA in general?
Yeah, great question. I should have said this earlier. So there's really the two main programs that get utilized the most are the 7A and the 504 program.
Okay.
The 7A is considered the flagship program. That currently goes up to $5 million in debt. That's mostly correct in that it's really $3.75 million of government guaranteed dollars associated with it, but from a high level, $5 million is the number that as a borrower, you kind of need to have that in mind. And another important thing about that cap is that it is tied to your Social Security number. So if you're a personal guarantor on one SBA note that's $2 million, in the eyes of the government, you only have $3 million left. So you can't, buy one for $2 million, then one for $4 million, and so on and so forth. You're always operating under that cap. And while you pay that loan down, let's say you do pay the $2 million down to $1 million. Well, now you've got $4 million available to you to go accomplish something else if you so desire. On the 504 side, that is a more rigid program. It's anywhere from 10 to 20% down based on very specific criteria as far as is it a special use location. At one point I was looking at a private racetrack, and so that would be deemed special use because if we had to sell it, there are not a lot of buyers for a private racetrack. And then the other being if the business is less than 2 years old. So that is associated with the entity from a generation of revenue perspective.
Okay.
So even if an entity has been around for 2.5 years, but it only started generating revenue about a year ago because that's when operations commenced, then that, in the eyes of the 504 program, that's only 1 year, so that's an additional 5%.
Okay.
You can go higher on 504 transactions, 10 to 15 million, certainly. But again, those are very stringent and only really for owner-occupied real estate or heavy machinery or equipment or a combination of the two. So that's why I kind of say the 7A is the versatile product. $5 million, though, is the limit on what someone can borrow.
Cool. Well, let's kind of wrap up with the same question we always ask, but with a unique spin on it, maybe for you. So the question is always, what advice would you give entrepreneurs, but maybe specifically from a banking point of view and somebody who is kind of new to the space and has a banking background, what's the advice that you would give?
Oh, man. I think being patient, that's one of the toughest things, especially as an entrepreneur and as somebody who works with entrepreneurs, and just doing your best to focus on the things that you can control throughout the process. And so, I work with entrepreneurs all the time who want to do 10 different things at once. And, it's part of my job to narrow that focus to, hey, these are the 3 things that we need to accomplish in the next week or two to be able to hit your deadline of, 90 days from now to be in this business or start up a business. And so being patient in the sense that you're always going to think that, your transaction is the most important thing to everyone else. And I think that's just human nature, right? And that's a humbling part too, being on the lending side is, it's my goal at all times to get, put the ball in the borrower's court or someone else's court, because especially the longer I work with small business owners, I mean, it's apparent that they've got, numbers 1 through 8 on their to-do list that day. And, talking to a banker's number 9, that's something I learned from public accounting too, is, no one wants to talk to the auditor before 9 a.m. and certainly not on a Monday. And so understanding, that while, on my side of things, it's, hey, working with borrowers is if I don't get a call back that day or the next day, it's because they have bigger fish to fry than me on the banking side. And then conversely, it's, understanding too that a bank is working on several, you are not the only individual that they're working with. And so, doing your best to strategize, what are the most important things, and a large, significant portion of that can be, resolved with just clear communication with your lender. And ideally your lender's having that clear communication to you too, to outline these, this is our area of emphasis for this week. If we, stick to these, we're going to accomplish your timeline. Because I think a lot of pain points can be resolved with that communication. And even if it's, on my perspective as being a lender, is even if I don't have an update for a borrower, it's just calling them and telling them there is no update today. I'll keep, I think it's probably going to be early next week because, as much as I would love to just be able to snap my fingers and wrap things up on our end, it's, our underwriters have got several deals on their plate. They're going to be, they have a certain amount of time like we all do, and they're going to do everything they can to accomplish this, but it might take, a little bit longer than, is on your original timeline.
Yeah. Awesome. Well, I think patience is always a good thing, Alex. So we appreciate you coming on, sharing with us, and look forward to sending some people over to have you help them.
Thank you, Troy. Appreciate you.